the ECB rate hike. This was a surprise this morning. So basically, expectations were to keep rates at 4.25%, and the ECB, the European Central Bank, actually raised them by 25 basis points to 4.5%. What's this telling us? It's telling us that Europe is continuing to see inflation. They feel that even with their economy essentially in a recession, they still have to hike rates. That's a big deal, folks, because again, it's almost like kicking an economy when it's down, essentially, when you raise rates further. So the fact that they feel like they have to do this, that tells you something about the state of inflation and what the ECB expects going forward. In other words, they don't expect it to be easily tamed on the inflation side, and they're having to put the pedal to the metal to get inflation under control. Now, next, let's talk about PPI because that's in the same realm. Now, it might be hard for you to see. I'm going to walk you through down here. PPI month over month, they expected 0.4%. The actual was, look, a whopping 0.7%. All right, now this is a big deal, folks, because again, yesterday we had CPI data, and CPI data was elevated as well. So now we're seeing even on the producer side, it is still elevated. Now, the one positive, let's talk positives. I'm a positive guy in general. One of the things that's positive, if you take out food and energy, which really, I mean, let's be fair, the majority of people are spending most of their money aside from rent or mortgages on food and energy. But if you took that out, you keep it at 0.2%. So 0.2%, 0.2%, it came in at expectations. So that's a small silver lining in an otherwise very inflationary situation that we are continuing to see. Now, let's be honest. Do we think inflation is going to go back to 9%? No. Do I think, and I've been saying this for 6 months, 12 months, I've said inflation is going to get sticky at 3% plus, and it's going to be very hard to take it lower than that. And sure enough, fast forward, we brought inflation down. The markets were getting excited. They were calling for rate cuts. Even earlier this year, they were saying by this point in the year, we would see rate hikes. Have we seen them? No. Are we going to see them? No. Are we going to see them early next year? Probably not. Maybe in the second half of 2024. So again, part of this, the fact is that I've been studying markets for 24 years, guys. It's crazy to think it's been that long because it's gone so fast. But I've seen this before. I've seen the way things work. I've studied cycles, and this is how they work. All right, so again, inflation upticking, we know that. If you take out food and energy, we know energy's obviously been on the rise. You get the 0.2 and 0.2%. Now let's keep going. What's the other economic news today? Was it good? Was it bad? What did it tell us? Jobless claims today, expected 225,000. We came in at 220,000. Now, jobless claims, remember, for those of you that don't know, these are people filing for unemployment. So it's actually the lower the number, technically the stronger economy. All right. So again, just remember that it's less people filing for unemployment, meaning less people are essentially losing their jobs. So this was a strong number. To be honest, that's not really good either, right? Because the Fed is trying to slow down the economy. They're trying to get people in a weird way to lose their jobs or at least weaken the economy a little bit. So this is strong, right? Then we look at retail sales, expected 0.1% month over month, came in at a whopping 0.6%. So the credit card users, the consumer, $1 trillion in credit card debt, and they're still spending. That's not good for inflation, guys. Now, again, please keep it in perspective. I'm not saying inflation's going back to 5, 6, 7%. In fact, I think it's probably going to stay around this area in the 3 to 4% range. But even at 3 to 4%, if the stock market drops 20%, right? If we see a 20% drop because the economy starts to tank, which I do think is going to happen by year end into 2024, how does the Fed print money again? How do they lower interest rates when you already have inflation at 3 to 4%? Because if you think about it, we were at 1 to 2% inflation and they lowered rates and printed money. And where did we go? We went to 9% inflation. If they start doing the same thing again and we're at 3 to 4%, where's inflation going? Is it going to 12, 15, 20%? Are we going to be the next Venezuela? I mean, what's going on here? So that's the big concern here, is that it's going to handcuff the Fed from really actively helping the economy in a major way, which means, and I've said this for a long time, those of you that have followed me know this, I've said we probably are in for a protracted, a long recession. It might not be a horrible recession. It may not be something like the Great Recession or the Great Depression yet, but it's likely going to be a long, drawn-out recession where things just kind of suck for a long time. It's not going to be horrible. It's not, I mean, well, for some, listen, already for some it's horrible, and I apologize for that. I feel bad for that. But for the most part, it's probably just going to be a sucky period that lasts a really long time.